Hey everyone, welcome back to Corporate Decoder, the place where we dig into the financial documents of companies. This time we are checking in on Byrna Technologies, a company that makes less lethal self-defense weapons. Are they hitting their targets or missing the mark? Let's find out if their financials can defend themselves. Byrna Technologies just released their Form 10Q, which is basically a quarterly report card. This one covers the period that ended in February 2025. We will go through the numbers, see how the company is doing, and try to make sense of it all. This Form 10Q is for the period that ended February 28, 2025. Think of it as a snapshot of how Byrna performed financially over those 3 months. It's a good way to see if the company is growing, struggling, or just staying the same. The commission file number is just a tracking number. It is not important, so we will skip it. As of April 10, 2025, Byrna had over 22 million shares of common stock outstanding. This is the total number of shares owned by investors and insiders, and we can compare the earnings with the number of shares to get a good per share profitability metric, which is very useful. Let's dive into the numbers. First, the balance sheet. This is like a financial photograph of what Byrna owns and owes. We are looking at two dates, February 2025 and the end of November 2024. Their accounts receivable or money owed to them by customers is almost 3 million, a bit higher than in November. Their inventory or products ready to be sold is about 23 million, also up from November. It seems that they are stocking up. They have also invested in marketable debt securities, basically lending out their money for low risk returns, and it comes out to 11.6 million. In total, they're reporting 71 million in assets, which are balanced against both liabilities and shareholder equity. It seems to be standard stuff so far. Looking at the other side of the balance sheet, what they owe decreased from 13 million to 11 million, which is great. Deferred revenue also decreased by a bigger amount of 1.3 million, perhaps indicating that they fulfilled a major contract with revenue coming in. Their total liabilities sit at a healthy 14.2 million. Now, a big thing to look at here is what's called accumulated deficit. As of February 2025, it was at negative 55 million. Basically, it is the total losses that a company has experienced over its lifetime. The good news is that it is getting lower. The company also has minor other comprehensive losses. Due to minor foreign exchange fluctuations, it is not very important. Stockholders' equity is at a healthy 56.8 million. It has grown in recent periods. Now let's check out the income statement, which is basically a summary of how much money they made and spent. We are looking at the 3 months that ended in February, comparing this year versus last year. Net revenue or total sales came in at over 26 million. That is a big jump of almost 10 million versus the previous year. Seems like their marketing and distribution efforts are paying off. Their costs, or the amount they had to pay for their products to sell, also went up, but less than sales did. This means that the profitability is also increasing and seems to be well managed. Their operating expenses, or the cost to run the business, is at 14 million. It seems that these also increased by a lot, so let us see if it was worth it. When we subtract their expenses, we get an operating profit of 1.7 million. This is a big turnaround from last year where they had a loss. This means that they improved considerably. The income tax provision seems negligibly small, indicating that they received big tax credits to offset any tax liability. Their bottom line or net income is a positive 1.7 million. That is a big improvement from the $17,000 they made in the same period last year. We are seeing profitability, baby. They also have a comprehensive income of 1.6 million. This translates to a basic net income of 7 cents per share and diluted net income of 7 cents per share. Let's move on to the statement of cash flows. The statement shows how the company is managing its cash, where the money comes from, and where it goes. Their operations are sucking up more cash than they did last year at negative 3.7 million. This contrasts to the good news of profitability that we found previously. This number warrants more investigation. The company is spending money to purchase property and equipment, which indicates that they expect to expand their production, which in turn reflects an internal expectation of high sales. The spending is about 5 million. They are not taking on more debt, which is a good sign of stable business practices. They have 7.6 million in cash. While this might seem like a lot, consider that last year they had 3 times as much. It seems that they are burning through cash, which in turn might imply a need to dilute through additional equity offerings. We can scroll past the statement of changes as it simply details the movement in the shareholder equity. All right, let's pause from the raw numbers and jump to the notes, which offer color about the business. Byrna makes less lethal alternatives to firearms with the goal to give consumers and even security forces a way to de-escalate dangerous situations without taking a life. They sell to individuals, retailers, and security companies. All of their manufacturing is done in Indiana and South Africa. The operations and management plan section says that the company had an accumulated deficit of 55 million, which is a big number. The key is that they had a profitable quarter and need to keep the income flowing to offset these losses. The basis of presentation is not too important, but it is important to note that it is unaudited. This means that their annual report, called a 10K, will give a more exact picture of their condition. Let's skip over recent accounting rules as these are a bit technical. Let us skip over goodwill too. It will not affect their business until they make an acquisition. Here we can find more information about their marketable securities. They are very low risk, consisting of treasuries and corporate bonds. For the 3 months ended February 2025, there were net unrealized gains on marketable debt securities of 0.1 million, indicating that these investments are making them some extra money. In August 2024, Byrna sold its ownership in a Latin American joint venture, Byrna Latam. They now have a royalty agreement, so they'll get a cut of any sales Byrna Latam makes. Advertising costs are expensed as they happen. The company spent approximately 4 million for the 3 months ended February 2025 and 2029-2024. Here's where they break down their revenue streams. Most of their revenue comes from e-commerce portals to consumers, with dealers and distributors making up the rest. They split the inventory into materials, work in process, and finished goods. It seems that they are investing a lot in raw materials for future products. They have 7.8 million in property and equipment after subtracting all depreciation. They have some intangible assets such as patents and trademarks. The most important assets of theirs are patents, which will bring revenue over a long time. The accounts payable is mostly made up of trade payables, salaries, and professional fees. There was also no repurchases during the period, in contrast with a stated goal of buying back shares. Stock-based compensation was high at 0.8 million. At least they are sharing the profits with the employees. We saw that their earnings per share was 7 cents, but that number will definitely fluctuate in the future. A director of the company also subleases space from them. These agreements are generally not a sign of malfeasance or fraud. The company has leases for property in various cities in the US, and we also learn when those agreements expire. Their income tax rate is low, indicating that they have been very clever in their tax management. They say that they are not currently in any legal proceedings, so there are no problems. They conduct business in many regions, with most revenue coming from the US and Mexico. They talk about risks such as currency risk and credit risk with their customers. They are also investing in low-yield bonds to lower risk. Looking at these results, Byrna seems to be in a stronger position than it was last year. They're making more money and their sales are up. However, there are some things to keep an eye on. Their operations are burning through more cash and their marketing and distribution expenses have increased. In addition, they seem to have taken on some debt for future expansion. Overall, I would say this company has potential but is also subject to serious risks. So it might be a buyer beware type of proposition. Their success this quarter is not guaranteed to repeat in the future, and the high marketing and expansion costs may hurt future profitability. Thanks for watching. If you found this breakdown useful, please like, comment, and subscribe. Let me know which company I should decode next.